G'day everyone and welcome back to this Share Cafe Hidden Gems webinar. Thanks for your time. Welcome to all newcomers. We always have some new investors online each week. And of course, the idea of these webinars is to create informed investors. Now today we will be talking financial services, we'll be talking real estate, we'll be talking innovative green technology, and of course captioning and translation technologies. We welcome back some companies, and we've got some new companies online for the first time. Don't forget to ask questions in the Q&A box provided. If you do note, and you have been here before, the CEOs will take time to answer your questions online live and or later on during the week when we send them those questions. So make sure you've got your email, don't be anonymous and ask questions. Okay, let's make a start, hey? First up, we have Prime Financial Group, ASX code PFG, market cap around $35 million, 1 year return of up 76%. Prime Financial Group provides accounting, wealth management and capital advisory services. We have with us Simon Matter, who is both Managing Director and CEO. Simon, welcome back. Over to you.
Thanks so much, Tim. Looking forward to presenting. Okay, thank you for that kind introduction. We might just flick on to the first page if we can. So in terms of the first half FY22, I'm pleased to present some pretty great results. This is off the back of a strong FY21 where our underlying EBITDA last year was up 21%. So we've followed that momentum into the first half of FY22. Our underlying EBITDA is up 20% to $3.4 million. Revenue has continued to grow. That was up 14% to $12.2 million for the half. And our reported earnings per share was also up 14% to 0.66 cents per share. We've continued our momentum of increasing our dividends. So our dividend is actually up 67% versus the previous corresponding period to 0.5 cents per share. Margins continue to improve. They're now at 28% in terms of an operating margin. And our cash flow has improved again, only albeit marginally, but it has also continued to improve. We've also had a focus on reducing our debt, now 0.9 times underlying EBITDA, but it was down 11% to $6.3 million. And that's down from around about $10.1 million a couple of years ago. So absolutely heading in the right direction. Next slide, please. Some other important things in terms of the half year just gone. We've been very conscious of how the work-life balance has been shifting for our staff. So we've actually reduced our office footprint. We are in Melbourne, Sydney and Brisbane. Our Melbourne office is our biggest office. So we actually reduced our Melbourne office footprint by about half. That's going to improve cash flow by around about $300,000 a year. But it's also recognising the fact that the majority of the team will want to be in the office around about 3 days a week. We've also had in place a capital management plan, which includes a buyback, and we've actually started buying back our own stock, and we've spent, as at today, around about $300,000 buying back our own stock. Next slide, please. So Tim was kind enough to highlight what it is that we do, but I'll give you a little bit more detail here. So we operate across Melbourne, Sydney and Brisbane, as I said before. We are an accounting, wealth, capital business. We do focus on business owners, family groups and professionals and executives as our key clients that we work with. But we very much focus on trying to empower them to achieve their aspirations. But it's not just about what they want to achieve in terms of their business, but in fact, our team. We have a team of 110 people that work diligently to obviously deliver service and advice to our clients. But where we really differentiate is how we interact with our clients. The way we try to surround our clients with a group of services and make sure that all of our professionals are talking constantly about ensuring that our clients get everything they need to achieve their outcomes and their goals. We have a centralised operating structure that we run for the business that allows us to keep our costs in check, and that is for IT, finance, HR and marketing. And we actually have a growing team that are in the Philippines, which also assists us to scale our business, which we have grand aspirations for over the course of the next 2 to 3 years. On to the next slide, please. This is an important slide. So as Tim said, we've got about a $36 million market cap. We're currently trading at about 10 times EPS, which is 1.73 cents per share. That's when you combine the second half last year and the first half this year to give you a bit of an idea in terms of run rate. We are paying a strong dividend. We're paying a 5% fully franked dividend at 0.9 cents per share. And that dividend is increasing, and the shape of that has been very strong over the last 2 to 3 years. The companies that we compare ourselves with are often quite a bit bigger than what we currently are now and trade at slightly higher, or if not quite higher multiples than what we're trading at. But the one that we focus on comparing ourselves most to is Kelly Partners, which is almost $250 million, is trading at a far higher multiple than what we are. The business is in good shape because we've got a dedicated team of people that actually own part of the future that we're trying to create. So we have 44% of our team own part of our business, which I think is a really important way for us to differentiate and make sure that we get the best talent to give the best advice to our clients. Over the slide, please. I've touched on a lot of these things, so I won't spend a lot more time here, but I'll just reinforce the fact that revenue is up 14% for the period versus the previous corresponding. EBITDA, underlying EBITDA, was $3.4 million, up 20%. Our diluted EPS was up 14%. It would have actually been up quite a little bit higher if it wasn't for an adjustment on the balance sheet due to the fact that we sublet some of our office space. The dividend is up 60% for the final that we paid on the 1st of October 2021. And the interim dividend was up 67% at 0.5 cents per share. That is being paid on the 1st of April. Next slide, please. In terms of our revenue and how our business is broken up, as I mentioned before, we have 4 key divisions within our business: accounting, wealth, capital, and SMSF, administration and advice. But 81% of our revenue is generated under the Prime brand, but we also joint venture with accountants that want to offer some of what we currently offer to our clients. And that's typically for wealth management, and that also makes up 19% of our revenue to bridge that 100%. Importantly, our business has a very strong profile around recurring revenue and existing customers returning to us every year. So 80% of our revenue is generated on a recurring basis from those continuing customers. And importantly, we've really been able to get our revenue moving in the right direction over the last 2 periods, so second half last year and first half this year. So that's now averaging around about 12 to 13%, whereas in the previous periods it was 3 to 4%. So we're heading in an encouraging direction, and one that I think supports our goal to scale our business. When you look at the shape of our revenue between what are 2 segments, so we combine the accounting and the capital division, that makes up 57% of our total revenue. 43% of our revenue is wealth management and SMSF, with our SMSF and wealth division really starting to grow quite strongly now in what is a great market for that particular division. So that revenue is up 22% versus the previous corresponding period, and we have high aspirations for that to continue in a very strong fashion. Our accounting, business advisory, and capital division, again, was up 9%, and we see that growing at double digits as well into the future. Next slide, please. We've been very focused in terms of our cost structure over the last 2 to 3 years, and if you look at this here, you'll see it's substantially within a reasonable range. The FY22 first half expenses look a little bit higher, but when you take out that lease adjustment for $500,000 at our expense line, they're again pretty consistent. Encouragingly, with revenue growth, cost control, we've been able to drive our underlying EBITDA up over the last 4 years. That's increased from 2.1 million to 3.4 million on a comparable basis. And as I said before, that was up 20% versus the previous corresponding period. Next slide, please. Operating margins overall have moved from 19% to 28% over that same period of time, and our operating cash flow is very strong. Almost all of what we earn turns into cash, which is important and has allowed us to reduce our debt, which you'll see there on the bottom left-hand side, but importantly, also pay out a really strong dividend to our shareholders. Next slide, please. This dividend shape, as you probably picked up from this presentation, we're pretty encouraged by. We target to pay out 40 to 60% of our reported and maintainable earnings, and we're doing that now. We're paying out around about 61% at the moment. But since our AGM last year, and the 26th of November, we gave guidance. If you look at that yellow box at the very right-hand side at the bottom there, we gave guidance that our final dividend for FY22 would likely be 0.5. That's what we were talking about at the November AGM. We're now really comfortable to say that that forecast is actually going to increase to 0.6, which is really starting to reward the shareholders for the hard yards that the team have been doing to grow our business. Next slide, please. Obviously, an important part of what we do as a firm, as a public listed firm, is trying to generate the most amount of profit, but importantly in the most ethical way, and giving back to our community. So the way that we have been scored by our clients through that typical net promoter score approach has been really encouraging. And obviously the community has been through a difficult environment over the last couple of years with COVID. But it's been good to see that the services and the advice that we've been providing to our clients has been valued. That's seen our net promoter score increase by 34%. And that really is a good indicator that clients that we deal with on a daily basis are willing to promote us or recommend us to friends and family. So we're very proud about that. Giving back to the community is also very important in terms of part of what we are doing as a firm. So we do that through supporting things like Oz Harvest, but also our staff having free time to go and give back to what they're passionate about themselves. Next slide, please. In terms of our strategic plan, so as a firm, we turn over between $24 and $26 million a year. We'd like to double that over the course of the next 3 to 5 years. But our purpose at the end of the day is making sure that we are empowering people to achieve their aspirations. We want to deal with clients that would like to grow their business, their wealth, and we want to support them in a very connected manner. That's our one connected team and service approach. We'll grow our underlying EBITDA over that period by continuing to maintain strong margins. We'll look at inorganic and organic growth. A lot of what we're doing at the moment now is organic growth, but as we scale the firm, we'll continue to look at further inorganic or tuck-in acquisitions, or people that have revenue or complementary services that would fit well within our firm. Technology is a big part of what we do. We report very openly and very clearly on what we're trying to do within the firm and make sure our team are empowered with the knowledge to drive forward the strategies for our clients. So growth for us will be about inorganic, organic, and driving additional services for our existing clients. Next slide, please. In terms of outlook, we're expecting for the year to increase our underlying EBITDA again by between 5 to 10% plus. We're going to accelerate our revenue growth. That should be between 10 and 15%. We'll continue to explore those growth opportunities, as I've already mentioned. The dividend will continue to increase. And on our final slide, I'll round it out before I throw back to Tim. Just one more slide, please. Thank you. We'll continue to reduce our debt. The buyback will continue, particularly as the share price is below what we consider fair value. And we'll continue to empower our team to own more of the business and to grow the purse for everyone. Thanks, Tim.
Thanks, Simon. Good to have you back. I noticed you did mention the word financial advice. Is that within the wealth management component? Where does financial advice sit within your model?
Yeah, financial advice is probably a primary consideration of what we're doing. It makes up around about 30 to 40% of our revenue. It's actually where the business was founded as a financial advice business. So we broadly put that under wealth management. And really, financial advice has been a very interesting consideration over the last 3 to 4 years. The number of financial advisors in this country has reduced significantly as things have changed and requirements have increased in terms of education, etc. And that audience, those participants have dropped from probably 25,000 advisors nationally to 17,000. And that means that there is still the same need for clients to get advice. And that presents a material opportunity. And you're starting to see that flow through as part of that financial advice and SMSF segment, which grew by 22%.
And I mean, financial advice on its own is generally quite a low margin business, but you've got decent margins here of kind of 27%. So where does your margin, that high margin, come from within the business?
Yeah, so if you look at the 4 different divisions, interestingly, they're pretty consistent. They actually range between 20% and 40%. Our financial advice division is actually quite profitable. We're lucky in terms of the way that we run our business, the types of clients that we work with that are willing to pay appropriate fees for the service we deliver. So the financial advice division generates about a 30 to 32% operating margin, the same as our accounting division. Our corporate advisory and capital division can be anywhere up to 40%. And our SMSF division, because it's scaling, it's only 2 years old, is around about 20%.
And your peers in the financial services stroke financial advice space, I mean, there's a lot of consolidation going on, a lot of acquisitions to achieve their scale and growth. Is that where you plan that to come from? Given you're also buying back shares and paying a dividend, how do you get that balance right between looking after shareholders but also maintaining growth?
Yeah, so I think we're really proud of our team that are very growth orientated. So we believe that every one of our divisions has got the ability to double in size quite easily from an organic point of view. So I think that will be the core focus, and that's what we've been looking at for the last 2 to 3 years. But you do come across really talented people that you'd like to add to the team, and they're often people, for instance, like last year, that had around about $1 million of revenue, but they were in too small a business. They wanted to join a business that had a similar philosophy, that had additional services. And so we see that playing out as well. So we see quite a few of those coming forward. So we balance it between the organic growth driving the operating cash flow, making sure we're getting the dividends in the hands of the shareholders. If our share price is below what we think is fair value, then we'll buy that back. You're constantly moving these levers around on a reasonable basis. But the goal at the end of the day is to grow the earnings of the business, and therefore you can pay more dividends, and obviously share prices improve as you increase your earnings profile.
And ultimately, do you see financial services being a high margin business?
Yeah, look, I think high margin is probably defined differently by different people, but I still think that within that professional services environment, if you can make 30% on turnover, potentially up to 35%, that's a really healthy margin. And I think the fact that a lot of clients, 80% of our clients are returning every year, allows you to keep on reinvesting in the business and making sure you've got a pretty great service. So yeah, I think that margin can continue, if not increase slightly.
Great, Simon. That's all we have time for. Nice to have you back. Have a good weekend, and we'll see you later in the year. Thanks
so much, Tim. Have a good day.
Next up, we have the agency, ASX code AU1, market cap around $18 million, 1 year return of minus 18%. The company aims to support and add value to the day-to-day lives of clients interested in property and wealth creation. We welcome back the group CEO, Geoff Lucas. Geoff, over to you. Thank you.
Tim, we have a minor technical issue. We'll actually go to the third presenter.
Okay, no problem. Let's hope he is available. The third presenter is Sparc Technologies, ASX code SPN, market cap of around $60 million, 1 year return of up 158%. The company is developing new technologies to disrupt and transform industry and science for a cleaner, greener and healthier world. We welcome Mike Bartels, who's the Managing Director. Mike, thank you for this last minute. Over to you.
Thank you, Tim, and good afternoon, everybody, and thank you for joining the webinar today. Next slide, thank you. I will start with a very brief introduction to the board. Stephen Hunt is the Executive Chairman, and Stephen has been on listed Australian entities as a director for in excess of 20 years and is currently a director of American Pacific Borates and started his working life with BHP. Daniel Eddington, together with Stephen, started the company, and Daniel's had over 20 years experience in the financial sector across a multiple of businesses and sectors, and is currently a director of Jade Gas. Our newest addition to the board, Stephanie Moroz. Stephanie has literally just joined us, and we're thrilled to have her on board. Stephanie's got 25 years plus experience in the hydrogen, battery and nanomaterials space, and also brings with her a wealth of corporate experience. So we welcome Stephanie to the board. Stephanie is currently the Innovation Manager with a global energy play, EDL, based out of Brisbane. Myself, I've been with Sparc now for just on 12 months. I had about 40 years worth of experience in the global multinational space, in the coating space with both AkzoNobel and Sherwin-Williams, And I ran businesses both here in Australasia and based out of Asia and the UK. And my strength has particularly been not only in managing businesses, but particularly driving growth strategies within those businesses. As you can see, our market cap at the moment is sitting around 60 million. We've had something of a journey of more recent times. And our shares at the moment are held fairly tightly with our strategic shareholder in the University of Adelaide still holding 8% of shareholding in the business, and directors and management hold about 15% equity in the business. Next slide, thanks, Tim. Our objective, we're very much a technology play at the moment, and it's very much about introducing new technologies to industry that are both disruptive and also serve to enhance existing industries. We're a relatively new business. The business was listed in November 2020, and it was listed on the basis of a graphene technology platform that came to us courtesy of the University of Adelaide. And as I touched on in the last slide, the University of Adelaide still holds about 8% in the company, is indeed a strategic shareholder in the company. Shares are tightly held, about 20%. About 20 shareholders hold about 40% of the shares in the company at the moment, so tightly held share registry. And at Sparc, we've arrived at focusing on two specific areas where we want to introduce new technology that's both enhancing and disruptive. And those two areas are graphene and energy. And it's important to also note that whilst these are two primary areas of focus, there is indeed a lot of synergy between these areas, which I'll touch on through the course of the presentation. Next slide, thanks, Tim. Graphene. Well, what is graphene? Graphene is an allotrope of carbon, which is just a fancy technical term for a derivative of carbon. It was discovered in 2004, which is a little hard to get your head around because you think that with carbon being so ubiquitous within our industries and just in general that it might have been stumbled across previously. But graphene was actually discovered in 2004 at the University of Manchester. And so significant was that discovery that the two physicists involved were actually awarded the Nobel Prize for Physics in 2010. So within a very short period of time, they were awarded that prize. So graphene has been touted for a number of years now as a wonder product, and that's because it has a vast array of fantastic physical properties and characteristics. And I'll just very briefly touch on those before we talk about how we seek to employ graphene as a building product in our modern society. First of all, it's got high mechanical strength, weight for weight and thickness for thickness. Graphene is 200 times stronger than steel. A little bit hard to get your head around. In terms of surface area to weight, 1 gram of graphene has a surface area in excess of 2,000 square meters. It's highly electrically conductive. It's highly thermally conductive. It's antibacterial and antimicrobial in performance, and it's also hydrophobic. So it has a vast array of properties that we are now seeking to exploit in industry. And indeed, the race is on, given all of these characteristics, for industry to adopt graphene as a material going forward. Next slide, thanks, Tim. So with this vast array of characteristics, we will indeed see graphene over a period of time incorporated into most of the modern products that we currently consume, and indeed it will be the precursor to new products being introduced to market as well. So at the moment, we're seeing research and development happen in building material spaces for graphene. It's already been adopted quite broadly in the electronic space. For instance, it's been incorporated into screens, mobile equipment. We're seeing it in battery plays at the moment. And it's also being employed in medical equipment, biosensors and the like. Because of all of these particular characteristics and the ability to play fairly ubiquitously with graphene, what's incredibly important is to be very, very focused in terms of what one wants to achieve in a graphene play. So at Sparc, we've arrived at wanting to participate robustly in what we call the building materials sector. And the reason for doing that is that we believe we've got some proprietary technology and the acumen to be able to add value in this particular space. Very importantly, though, this is a multi-billion-dollar sector. It's established and it's global in its characteristics, and it therefore offers very significant commercial opportunities for us in the event that we deliver the products that we are looking to deliver. The customers within this segment invariably have very large ESG objectives, and again, graphene can play a considerable role in helping our target customers deliver their ESG objectives. Sparc Graphene is concerned with what we call the formulation and adoption of graphene-based additives, and I'll sheet that graphene-based additives piece home on the next slide. But we're specifically looking at targeting coatings, concrete, and composites at the moment. Now, in the graphene space, there's a lot of literature. There's something like 2 million sites that you can go and visit graphene. There's a lot of people producing graphene at the moment and foisting it on customers and expecting their customers to be able to do something with it. We're very different from others in the graphene space. Our modus operandi is to actually take graphene as a raw material and to actually formulate with it and to add value in what we would consider to be very targeted end uses. So what we're looking to do at the moment is to liaise with targeted customers, arrive at what they consider to be opportunities or indeed problems that need to be solved, and formulate products for a targeted end use. Now, a lot within the graphene space at the moment is simply producing graphene and dropping it into what we would call very simple dispersions with a primary want to simply aid handleability. What we're doing is looking at producing a formulated material based on graphene that delivers a specific outcome for our targeted customers. Now, because of that, we've actually elected at this point in time not to be a graphene producer per se, and that's because we don't want to be captive to a graphene production process that dictates the type of graphene that we import into the products that we formulate. So again, we differentiate greatly from others in the graphene space in that, one, we don't produce graphene, and two, we see graphene as a raw material with which to formulate for specific targeted end users for targeted customers and outcomes. In terms of where we're at the moment, after only 12 months or a little bit over 12 months, we've got a fully functional, purpose-built and designed research and development facility now in South Australia that's tooled up with all of the necessary equipment and folk to be able to drive all of that equipment. In addition to our own R&D activities in-house, we've got a number of collaborative arrangements in place with Australian universities. We spend a lot of money on R&D, both in-house and also too with Australian universities, and we collaborate with the likes of RMIT, Flinders University, Melbourne University, University of Adelaide, of course, as a strategic stakeholder in the business. So we've got plenty of fallback in terms of university support that we can draw upon. In terms of our capability set at the moment and what we're taking to industry, we're taking to industry that we have developed, and this is indeed quite unique, an inherent understanding of graphene and what is known as a characterization of graphene. So what is a relatively new material, we actually inherently understand what graphene is. And to coin an old phrase, oils ain't oils, graphene most certainly isn't graphene. And you really need to understand the characteristics of each graphene material that you're looking at in order to import those characteristics that you wish to take to a targeted end use. We obviously know how to formulate graphene-based products, both in terms of materials that can be readily dropped into what are already commercially available products, or indeed in some instances, we're able to formulate finished coatings that will serve to be disruptive in the coating space going forward. Very importantly and critically, talking to our customers, they want to know about our ability to both manufacture and scale up in this space. It's very important because graphene can present some problems in terms of handleability, and we're working through those issues with customers. we have significant R&D capabilities that we've built up with time. And very importantly, I've said here, active program regards patenting. Indeed, we've got a very aggressive program in terms of patenting, and we hope to close out some patents in the not too distant future. Next slide, thanks, Tim. Based on work to date, we're very confident about being able to deliver some major outcomes in the coating space in the not too distant future. We're entertaining a number of global coatings companies at the moment and looking to advance our position with them. As I just touched on, we've currently got discussions in place with a number of global paint companies, and the objective is to have formal collaborative technical agreements in place very soon as a precursor to commercial arrangements. And those commercial arrangements could take the form of either selling graphene-based additives to those global multinational coatings companies, or indeed licensing know-how. Critically in this space, we've got direct access to these customers. We know who they are and they know us, and we've got the expertise to be able to carry the day. And our approach in coatings will now be taken into both the composites and concrete markets, which we're also targeting. And that approach is very much about formulating for a targeted end use, doing lots of testing to recognised industry standards, and employing the appropriate subject matter experts to be able to carry the arguments with those customers. So we believe we've got a very good position in the graphene place or space at the moment to be able to advance our commercial aspirations there. Next slide, thanks, Tim. Sparc green hydrogen. It'd be fair to say that in terms of graphene, we're primarily looking at enhancing our customers' products that are currently in place. With our Sparc green hydrogen play, we're very much looking at introducing something that is genuinely disruptive in the industry. And by disruptive, we're introducing a process called photocatalytic hydrogen production. And this is a process by which we simply have a unique means of capturing the sun's input, which means that we don't need to displace or generate renewable energy in order to produce our green hydrogen, nor do we need to employ what is typically used in this space at the moment, which is called electrolysis. So we genuinely have something that's disruptive in this space. Might go straight to the next slide, thanks, Tim, and start to show some graphics in this space. You may have heard a lot about the colours of hydrogen, starting with grey hydrogen. This is hydrogen that's produced courtesy of what they call steam reformation. And this is simply where you take fossil fuels, subject it to steam, and split hydrogen out courtesy of that process. Blue hydrogen is exactly the same type of process, but it captures or entails the introduction of carbon capture, and hence the name blue hydrogen. It's not seen as being as environmentally unfriendly as grey hydrogen. Green hydrogen, which I just touched on, is where renewable energies are used to produce hydrogen courtesy of the introduction of electrolysis. And then we have our Sparc green hydrogen, which is all about the unique means by which we seek to capture the sun's input into a photocatalytic material. Next slide, thanks, Tim. Okay, and this is where it all happens. What we have front and center in terms of this process is a reactor. This reactor is where the photocatalytic material resides. And what we're all about with regards to this process is optimizing the way the sun interacts with the photocatalytic materials that reside within this reactor. Now, it's worth also shooting home the fact too that photocatalytic chemistry is not new to industry, but this process is all about what we call the optimization of sun to hydrogen ratio, or the optimization of that particular ratio. We have a patented position with regards to the way we will engage the solar interaction with the reactor, and we also have a patented position with regards to the photocatalytic material that sits within the reactor. And courtesy of that, we'll be able to deliver something in this space which is entirely new and, as I said earlier, disruptive. Next slide, thanks, Tim.
Mike, I just might interrupt you 1 second
and
just suggest we've got probably got a couple of minutes left, if that's okay.
Okay, thank you, Tar. In terms of what is typically captured as green hydrogen at the moment, and what we will indeed see play out in the near term, is what we call green hydrogen through the use of renewables and electrolysis. So this is simply using, excuse me, solar or wind farms to generate renewable and to be able to drive an electrolysis process that subsequently drives the creation of hydrogen. And if you look at this particular process, our process doesn't need to generate renewables, doesn't need the electrolysis, and simply has a unique means by which we capture the sun as it interacts with that photocatalysis that sits within our unique reactor. Next slide, thanks, Tim. This is I guess the slide that really sheets it home. If you look across all the different colours of hydrogen that we touched on in the earlier slide, it really does show the competitive advantage or the unique selling proposition that Sparc Green Hydrogen has relative to others. So we're a unique process in that we're all about photocatalysis, which is, again, a technology that's already well understood but hasn't been able to be optimised. So our process is very much about optimisation. Our feedstock is water. And interestingly, just an interesting fact, for every 9 litres of water that's introduced into the process, a kilogram of hydrogen is produced. The byproduct of our process is pure oxygen. So there's no nasties come out of our process. Carbon emissions are therefore nil. Location is only restricted by what solar resources are available. And one of the things that's very unique also about this particular process, because it doesn't need renewables to be produced, because it doesn't need large-scale electrolysis to be supported and driven, our process is also eminently scalable. So that's also a unique selling feature as well. The next key milestone with regards to this project will come circa the middle of this year, when our preliminary techno-economic analysis will be produced. And our expectation to this point in time is that we will actually be confirming to the market our ability to deliver hydrogen at the lower end of the cost curve. And of course, the government has a statement out there at the moment that they'd like to see hydrogen sitting around that $2 per kilo position. And that's certainly the minimum objective that we're setting ourselves with regards to this position. What's important is, so I was just going to offer, Tim, that what is important is that, as we touched on earlier, I touched on earlier, graphene is able to be employed through the hydrogen process. There are a number of areas that we're exploring at the moment, and we're working through projects. So there is most definitely synergy in that space in terms of graphene interacting with our hydrogen play as well.
Thanks, Mike. We are out of time, I'm sorry. There are several questions there online. If you could answer those just by typing the answers in online, yep. That'd be most appreciated. It's a really interesting presentation. I appreciate you had a lot to get through. So thank you for your time.
Good, and thanks very much, Tim. Thank you, everyone.
Next up, we have AI Media, ASX code AIM, market cap around 124 million. Stocks had a 1-year return of minus 27%. The company makes captioning and translation technologies available to everyone around the world, across purpose, across industries, across platforms, and across languages. We welcome back Tony Abrahams, who is both the co-founder, director, and CEO. Tony, nice to see you. Over to you.
Thanks, Tim, and thanks very much for having me. And it's great actually to be joining you from New York, where I'm visiting our latest acquisition for the first time, a $50 million acquisition of EEG Enterprises that we completed in May of 2021. Next slide, thanks. And yeah, so as Tim said, AI Media is a global technology company, and we deliver live and recorded captioning, transcription, and translation services. Next slide. Now, this last 6 months and I co-founded this business 19 years ago. last 6 months has actually been the most interesting that I have ever been associated with the business. For many, many years, live captioning needed a human being to intermediate the process of going from live speech to text that was accurate enough for people to understand. In the last 6 months, the need for that human in the middle in real time has disappeared. And it's quite a profound change to the industry. It's one that we anticipated in our IPO in 2020. And it's one that we very much prepared for with that acquisition of EEG here in New York that I was talking about. Many of you will have experienced live captioning for the very first time in that 6 months, I dare say, while using Zoom or Microsoft Teams and clicking on the caption button that is at the bottom of the screen and seeing the automated captions come through. Now, as I said, traditionally, that captioning quality has not been of a sufficiently high quality. And what you've needed instead was a means of human intervention in the path of that live speech to text. And that was done either with a stenographer who had a stenography keyboard like a court reporter that you would see on TV, someone who's trained for 3 to 5 years, and they would output that text at the speed of speech at an accuracy level of about 99 to 99.5%. The other way of doing it was with a re-speaker, someone who had trained the speech recognition engine to their particular voice. And because they'd trained it to their particular voice print, you could get that 99 to 99.5%. Now, these automatic speech recognition systems don't do quite as well. They do about 97, 98%, but it's a lot better than what was capable of being achieved before. Now, obviously, with the advent of free automatic speech recognition tools on enormous platforms like Zoom and Teams, we have seen some headwinds this year in terms of some of our legacy customers that we have been providing for switching over to these free tools. But what's really exciting, and off the back of our EEG acquisition, is that we are incredibly well placed to take advantage of this shift towards automatic speech recognition. And of the $14 to $16 million that we've lost in terms of where we had thought we would be this year, but for the widespread introduction of ASR, we've gained all of that back through our own ASR initiatives over our proprietary ICAP platform. And I think that that's really been the most exciting thing that's happened in the last 6 months. Next slide, thanks. So automatic speech recognition, also called ASR, is a free tool that's available on demand on many platforms like the one we're using today. This has seen a downgrade effectively in our revenue for FY22 off the back of a lot of work that we'd historically been providing for either deaf and hard of hearing students in workplaces, in universities or at events, who've moved to these free on-demand tools. But the really interesting thing, and these free on-demand tools came in around about August to September last year, so very, very recently. But they now contribute over 130 million minutes of captioning each month. And by contrast to that 130 million, we deliver about 7. But we deliver 7 million minutes in the very, very high professional end. And this is the environment where that walled garden is something that we own. And that's seeing this increase in share to top tier SaaS revenue. So despite the fact that we were talking about effectively flat pro forma revenue, the margin and EBITDA performance is significantly improved. And we're really excited by the pipeline that's coming. Next slide, thanks. So this slide really articulates the transformational impact of that EEG acquisition. And what that EEG acquisition does is it recognizes that the value in the live transcription, translation, and captioning space is not necessarily going to accrue to the person that can provide the best captions. It's actually going to accrue to the provider of the walled garden that the captioning can be distributed across. And where this is Zoom or where this is Microsoft Teams, AI media sits at a disadvantage. But by acquiring EEG, what we acquired was this incredible ICAP network that delivers over 7 million minutes of professional grade captioning, both automatic and still 80% human curated, with around a 95% market share in US broadcast and a less than 5% market share globally. And what we've built over recent years is the global sales and marketing teams to help take this product suite around the world. We've been the reseller of this product for several years and really seen this drive huge customer uptake. And the key to this is really on the left-hand side and the right-hand side of the screen here. I mean, when you think about the problem of delivering live captioning, it's not just about how accurate can you get the speech to the text. I was at an event in December at the overseas passenger terminal at Circular Quay in Sydney. And it was probably the first event where there were full of tables after COVID. And I think everyone was so excited to see each other that it was actually very difficult to hear the speakers up on screen, up on stage, who included the minister, the chair of Tesla, and a bunch of people who had gone out of their way to deliver some really important statements. And I noticed around the room that there were a bunch of television screens where people could see the presenter, but there was actually no captions on the screen. And of course, there were people trying to quiet everyone down to little effect. And I went up after the event to the organizer and I said, well, you know, I work at AI Media, we do captions. Why don't you have captions showing on this screen, which could allow people to follow, notwithstanding the fact that the noise levels were too high? And they said, look, we just didn't know how to get the captions onto those TVs. We knew how to actually generate the captions, but we couldn't actually display the captions on the TV. And this is half of the product suite that we acquired from EEG, which is that display technology on the right. So it's something that allows, with very, very easy manipulation by an AV team, where on the screen they want those captions, what font they want them in, and so forth. A very interesting thing that you may not realize, thinking about the generation of captions, but actually the presentation of those captions on screen is really critical. Most captions out of the box turn up white. If you're looking at white captions against the Winter Olympics, that's not going to be a great viewer experience. So there's a lot of nuance in the way that these captions are presented in a professional setting that's actually really important. And we do provide the captions for many broadcasters who do deliver captions to the Olympics and Winter Olympics, including Channel 7 in Australia and NBC in the United States. And then on the left-hand side, that's also a really important part of the product suite we gleaned from EEG. And that is how you actually encode the video into the process so that you can then overlay captions or transcription or translation. And that transcription, captioning or translation can be done in one of three ways. And we've represented that as Lexi, Smart Lexi, and Premium. And effectively what that means is it can be done in either a fully automated way, in either a fully human curated way, which is AI Premium, or in this hybrid way of Smart Lexi, where effectively what you're doing is you're providing some parameters to the automatic speech recognition engine about the type of content that is going to be delivered, and you set a dictionary appropriate to that particular content. So for example, if you're talking about a cyclone in Western Australia, you want to make sure that you're putting the word Seroja in that dictionary, because otherwise it's going to be completely garbled. But that little bit of curation can actually make a big difference. And people online can see the difference. If you want to turn on channel 9 or channel 7, it's typically the AI premium captions. If you turn on Sky News Australia or TVSN, you'll see the Smart Lexi caption. Next slide, thanks. So for the first half, we had a 29% revenue growth, but that did include the acquisition. So on a pro forma basis, we're talking flat. But the really interesting part is the shift in the quality of the revenue there, with a significant increase in margin from 38% to 53%, a trend we expect to continue, seeing gross profit up 78%, driven by a near doubling of our automated and semi-automated ASR products, a $7 million turnaround in our EBITDA performance to break even, a $15.9 million cash balance, and a buyback program, which we have just restarted after the half-year results. Next slide, thanks. We've also seen a number of really exciting pipeline developments. Very little of this is actually in the numbers that we reported. So we're seeing 3 global technology companies, 3 of the top 5 global technology companies really deepen their relationship with us. We've switched on 2 new parliaments, being the UK Parliament and the New South Wales Parliament, and 1 large international sporting organisation who have doubled their spend with us by the fact that they have increased the amount of content that they're showing on their over-the-top platform. We've also managed to convert 4 of the top US broadcast networks across to that automated captioning across that ICAP network, being NBC, Fox, ABC, and ESPN. And we've switched on new customers, being Sky News Australia and TVSN in Australia, and GB News in the UK. Again, very little of that is in the review mirror in terms of result. Next slide, thanks. And what you can see is we've, while we've held the revenue broadly steady on a pro forma basis, the quality of that revenue is increasing very quickly towards that SaaS and devices revenue that each deliver gross margins of 70 and 75% versus a traditional 40% gross margin for our tech-enabled services business. Next slide. And here, what you can see is, I mentioned that there were 130 million minutes being done by Teams and Zoom. We're doing around 7 million minutes a month. This graph is in quarters. So it's heading towards about 20, just north of 20 million minutes a month. The graph on the bottom really demonstrates the share of the total amount that is being captured by our new automated services, which really are delivering a quality level much ahead of what you would see on those free tools of Zoom and Teams. And that represents that middle light blue layer as well. Next slide. Tim, you're on. So you can see this is on the ASX platform, but the key thing here that we will continue to trace is that the light blue component continues to increase faster than the dark blue component, although we also want to increase that dark blue component as we take this very successful network out of the United States globally. And Tim, I can pause there.
Tony, you can keep going. Actually, we've lost the agency for the rest of the day, so take your time. I'm just a prompt.
Okay, no worries. Last few slides, and then we can go to questions. Next slide, thanks. So we are providing guidance for the full year, and notwithstanding that $14 to $16 million headwind, we are expecting now to stabilize and grow as the tailwinds from that shift to automatic speech recognition really swing in our favor, and swing in our favor in the medium term rather than the short term. What we're forecasting is a gross margin of 53 to 54%, and a positive, which means, you know, break even to positive EBITDA for the full year, which obviously is a significant turnaround on where we were this time last year. Next slide. The key here then in what we're investing in is continuing to build out that ICAP platform. So the network that connects the encoding on the left-hand side of the page and the display on the right-hand side of the page, and then the insertion of the captions in the middle. It's continuing to invest in its security, its resilience, and its speed. And then also working on channel partnerships for success right around the world. So we just launched a preferred partner program where integrators, technology integrators and resellers can resell our services for a 25% revenue share. And ever since announcing that, actually, even just last week, we've been very, very positively engaged with people who are really looking at technology that's been proven as being the best in the United States in terms of the core infrastructure, the best in the world in terms of what we've been delivering here in Australia for premium quality content, blending the two of those together, turning it into a scalable proposition, and then taking that out into the world in the context where everywhere in the world is now focused on implementing the International Disability Convention, which is something that's kind of similar to the Climate Change Convention. There's an acknowledgement that by 2050 we want to make sure that people with disability have equal access to the world that all of us enjoy. If people have deafness or hearing impairment or speak other languages, then the captioning and the transcription is kind of critical to that. The fact that we now have an automated solution and you're not reliant on having a human being there all the time has suddenly then made the economic case for implementing this much more significant. And then when you then think of the downstream benefits that you can get from having that text, such as being able to clip and search content, find it, easily archive it, personalize it, and serve it up to people based on a huge content library, then yeah, we think we're kind of just getting started with that partnership approach and adding value for these really top tier customers.
Thanks, Tony. I'm fascinated by this industry. I think in your previous presentation some time back, you spoke to the size of the industry. Can you remind us of how big the industry is?
Yeah, as a whole, the language services industry is about $30 billion a year, and growing above trend as well.
And who are your main competitors in this space, and how is your IP around your technology differ from those sort of competitors and their products?
So what's really interesting is that the main competitors are on. We have competitors that work with us on the services side, that we come up against on the services side, and I would say the biggest competitors that we have there are companies like Verbit, VERBIT, 3Play Media, and Rev, as well as Red Bee Media. But then if you look at the sort of infrastructure side of things, then it would be players like Evertz would be the main one. But the interesting thing is that we actually have partnership relationships on both sides of the fence with kind of the complementary product set that we offer. So no one's actually, there isn't anyone that actually has done the vertical integration step that we have with the proposition that we would be a one-stop shop kind of live languaging solution for someone that wanted to make their content accessible and be able to do it at kind of the drop of a hat. And I think the other thing that's really critical around this process is the timing of the upgrades that a lot of our customers are doing is quite good right now, because they're all moving to IP delivery, which has just been agreed on a particular standard, which is the 2110 standard, and all of the products that we have are completely 2110 tested and native, so that, you know, the implementation for, say, the Olympics for NBC was a matter of weeks, because all of the software solution is virtualized or in the cloud, and it's already proven compatible with the 2110 standards that people are broadcasting increasingly kind of on over the top material. You know, the way that EEG business, I mean, you know, it was only doing $10 million a year in revenue, but it had like over 90% market share for equipment in broadcasters in the United States. And that's because you only need to purchase like one box for each channel, and there's a finite number of channels in the United States. But now that there's just so much more content being distributed, whether it's streaming, whether it's over the top, or whether it's, you know, in countries outside the US, and the fact that you don't necessarily need a hardware box anymore, but you can actually deliver all of those services through the cloud or as a virtualized kind of install on a customer's piece of hardware inside their kind of secured walled garden. You know, it's a really interesting proposition for customers that go, oh, how am I going to connect with, you know, more people? You know, could I show this content in, you know, French, German, Chinese, Italian, and let people choose the language that they wanted to actually read the captions in for a few cents a minute. And that's kind of where this technology is just kind of, they're the kind of decisions that this kind of shift in technology towards automatic captions being good enough. We're really just at the very beginning of seeing the impact of that.
Yeah, it's interesting. And so some of the platforms that are providing the free automatic speech recognition tools, I mean, generally these big platforms that provide free anything then upsell into something eventually. Does that mean they're the sort of platforms that look to make acquisitions so that they can potentially acquire you or build or acquire something else in this kind of SaaS space and offer more products that they can on-sell beyond just those free customers?
Look, that hasn't happened, and I think it hasn't happened because the organizations that are making the automatic speech recognition engines, it turns out to be a lot easier to make an automatic speech recognition engine than people perhaps thought even 3 or 4 years ago. And so there's literally dozens of automatic speech recognition engines to choose from now. So in fact, the smarts of our Lexi product is that it's actually a wrapper around any automatic speech recognition engine. But it's a wrapper that then remembers things like if you're translating an idiom from English into German, to translate, you know, what is an effective idiom for that. So for example, if you're saying I'm going around the corner in English, you would have to say, you know, kind of the German equivalent of it would be I'm going around the 4 corners. Or I'm going around the block would be I'm going around the 4 corners, right? And so if you say I'm going around the block and you translate that to German, it just doesn't make any sense. And most of the speech recognition engines don't actually do that bit well. So that's what we call translation memory, and you sort of host that translation memory outside of the confines of the actual kind of speech to text engine. And therefore what you can do is you can effectively take your IP that you've generated around that translation memory, around, you know, speaker recognition and things like that, and then overlay it on top of these machines that are getting better and better and better because you know, talking to your Tesla or, you know, to your iPhone, I mean, these are huge industries. And we're actually getting the benefit of that as an input into the product that we're ultimately selling. And what we're about doing is kind of taking it that last mile, so that when we're engaging with like the you know, professional broadcast enterprise government customers who really getting the best possible quality given where you know, the technology is, then we were in the right place to provide them that kind of level of comfort and a sort of, you know, 99.99% kind of uptime which is, you know, what we've historically been delivering for, you know, customers like Channel 9, Channel 7, the World Economic Forum, you know, UK Parliament and so on. So it's taking the kind of free automatic stuff, making it professional grade, but doing it through technology, not actually requiring like human services delivered. And that's the transformation that we're kind of 6 months into. And I think it's looking pretty good at the moment.
Yeah, no, really fascinating, Tony. That's all we have time for. We've given you lots of time, and appreciate the
Thanks,
time given you coming to us from New York. So thank you. Okay, that's all we have time for today. Unfortunately, we couldn't bring back the agency. We'll have them on next week instead. Have a nice weekend.